So, dear ladies and gentlemen, my name is Heidhues. I'm the Lufthansa Chair for Competition and Regulation here at ESMT. And on behalf of the MBA class, the current MBA class who organized this event, and especially Maggie McManamy, who was the driving person behind this but is sick today, I'd like to welcome you to today's ESMT panel discussion on can the ECB help solve the euro crisis, should it? So there's a number of interesting questions already in the title. We probably know what the ECB is. I'm interested to hear whether we know what the euro crisis is and agree on it. I'm also very much interested to learn whether should it has the same meaning to all of us. And when I say all of us, of course I mean the audience who's going to participate in questions and answer later, myself as the moderator. But more interesting are experts today, our expert panel. And we have three experts. Let me introduce them by distance traveled. So let me first very much welcome Hans-Werner Sinn. He's the director of the IFO Institute in Munich. To economists like myself, he's most known for his work on economic decision-making under uncertainty, economic growth models, environmental economics, general equilibrium, and many other academic papers. If you go to his webpage, at least if you're an academic economist like myself, you get very depressed. The number of invited lectures he's given is just amazing. And these invited lectures were early in his career not on policy topics. He's done really fundamental contributions to many areas of economics. He then also headed the German Verein für Sozialpolitik, the German Economic Speaking Association, which he very much revolutionized and modernized. I think even its current president will agree with that. He has even gotten he was one of the first prize winners of the Gustav Stolper Prize, which at some stage the German Economic Association, after he was not the president anymore, decided that maybe academic economists are very little heard in the policy debate, and they gave a prize to people who also contribute to the policy debate. And I think to most non-economists, he's much more known for his many contributions to the public policy debate, again on many areas. And in particular, I think a big contribution, and one that is perhaps controversial but extremely influential and important, was he was first to point out the target saldo issues in Europe, and building on that contributed a lot to the discussion on the European crisis, or the euro crisis. I will not mention all the honorary doctorates, nor other affiliations or famous places he has visited. I will just skip to the next person by travel distance, not quite so far. You can almost see where he came from. Michael Burda, who managed to walk all the way over here. Michael Burda is also an influential economist. Michael Burda has won the Gossen Prize for the best economist under 45 in the German-speaking economic area. Although, as most of us know, especially the MBA class that he taught, he got his degrees in the US at Harvard before moving here, although he studied in between in Göttingen, so he was influenced by German economists early on. He now teaches economics at Humboldt. He's the current president of the Verein für Sozialpolitik. He's also been heard and active in the policy debate. And with the travel distance, you know that the introductions get shorter. So last but not least, let's come to our president here at ESMT, Jörg Rocholl. He is not an economist. He's a professor of finance, who, however, has also actively and often contributed to the debate on the euro crisis, and in particular to its finance aspects, for which he's most known of, maybe also the gambling of banks and some of the distortions that are involved with regulations in this sector. But I will not try and foreshadow all of your comments. We will now start giving each person, each of the experts, a 5-minute introductory statement. And after that, there will be discussion among the experts for a good half an hour to 40 minutes. And then there's a question and answer session where I hope for the active contribution from the audience. And so let me start with, again, travel distance, and have Hans-Werner Sinn give a 5-minute introduction on the title of today. So, can the ECB help solve the euro crisis, and should it?
Yeah, so go ahead. I hope this works. Thank you very much for the invitation to this gorgeous place. I'm really impressed by the art which I see here. I mean that honest. Yes. We have 3 crises. We have a sovereign debt crisis, we have a private debt crisis, and we have a real competitiveness crisis in Southern Europe. Can the ECB resolve them, and should it? Well, the first 2 crises can be solved by the ECB, but the third not. The ECB can calm the financial markets through its actions. That helps the governments to get cheaper finance for the time being. They can continue borrowing. And it also helps the banks of Southern Europe, which are in the center of the private debt crisis. But the ECB cannot make the Southern European countries competitive. To the contrary, there is a conflict. The more the ECB calms the markets, the more attractive European assets become for international investors. The more expensive is the euro, the more difficult it is for the Greek to sell their products or, say, attract tourists. Should the ECB calm the financial markets? No, not to the extent it does, because it harms the real economy by doing so, and because what it does is largely illegal. We have the Maastricht Treaty, which specifies in Article 123 and 125 that the ECB cannot do things which other central banks in the world can do. For example, the Federal Reserve in the United States. It cannot monetize states, and it cannot bail out states. That's what these 2 articles say explicitly. The German Supreme Court is currently dealing with these issues, and we will hear, probably by the beginning of the next year, their opinion. They won't come out now because Germany doesn't have a functioning government. The no bailout clause, I think, is most clearly violated. This was the pillar of the construction of the ECB system, on which Germany had insisted when it gave up the Deutschmark, because everyone knew that we would be coming together with over-indebted countries. So the fear was that one would have, in one way or another, to take over their debt. And so the German negotiators insisted on the no bailout clause. If a country goes bankrupt, it goes bankrupt, and it is not possible for the other countries to help it. It's not even allowed, if I believe in the Supreme Court Judge Di Fabio. That's a gray zone for me as an economist. Is it not necessary or not allowed? He says not even allowed to help. This pillar of the Maastricht Treaty has been destroyed with the decisions of the ECB, in particular those decisions that came in May 2010, namely the ESMT Program, the purchase of government bonds, with the OMT Program, the announced unlimited purchase of government bonds, but also with the abundance of refinancing credit which the ECB made available to the banks of Southern Europe, which these banks then used to buy government bonds. All this, what it did, probably prevented the euro from collapsing. If it had not acted, we wouldn't have the euro anymore. Still, the decision about whether or not we want to have the euro is not up to the ECB. It's a currency decision which is to be made by the parliaments of Europe. The ECB has to act within its mandate and does not have the right to define the mandate. This is the issue of competence, also in German, Kompetenz, which is the fundamental question about the ECB. Does independence mean that it can define itself what it wants to do? The legal answer clearly is no. It cannot, and in particular, it cannot take actions to save the euro. This is legally not their function. They have to do monetary policy, and the decision about measures to save the euro has to be done politically by other bodies, and then possibly the Maastricht Treaty has to be changed. This is important because the question is the euro so valuable that, for example, the ECB is allowed to put the wealth of some of the European countries on the table as a guarantee sum for others? This is a difficult issue. Not the ECB can decide about it. This has to be decided by policymakers. That should be enough.
Thank you very much. Thanks for staying within your 5 minutes. Michael?
I guess I have to look at my watch now. Well, I have to agree with most of what Hans-Werner said, except for a couple of things, and they're probably the most important things. There are three crises. I think everyone agrees with that. There's a sovereign debt crisis, there's a banking crisis, and there's also a crisis of underlying competitiveness, which has been going on for some time. I think we would disagree on who's responsible for it. I think the Southern European countries are only partially responsible for it. I think it takes two to tango. So the lenders that pushed money down there in the beginning of the monetary union are kind of responsible as well. Someone didn't do due diligence, and in effect, the whole euro plan, despite all the bureaucrats that were involved, was still very poorly executed. I was so in awe of the way they introduced the money the day, January 1st, 2002. For economists, this is such a fantastic example of monetary neutrality. Nothing really happened. People woke up and we had this euro. But in the end, there were so many fundamental institutional flaws. And Hans-Werner Sinn talks about the no bailout clause. That was never credible. Effectively, we had this on paper, but it was never time consistent. And many economists actually recognized that, but they were never heard. I think I remember Fowell actually talking about how these things were just not credible. But it's not beyond the purview of economists to design credible institutions. I just think we just didn't do a very good job, or the bureaucrats that were supposed to execute didn't do a very good job. And I think that should be in the back of our mind. I mean, I think we didn't have a Bretton Woods-like system, although we had a Bretton Woods. The euro is kind of like the gold standard, and because countries were allowed to run deficits on balance of payments with each other inside the euro area, it gave rise to what Hans-Werner Sinn called the target imbalance problem. But in the IMF system, the IMF was the policeman to come in there and say, you can't do that. And when America had its balance of payments problems in the 1960s, and Great Britain and Italy had their problems in the 1970s, the IMF came and put a program on them, and these programs were accepted. And I think all that Germany has tried to do, and with the help of some other Northern European countries, is try to impose a program. But they should have developed an IMF at the beginning. We needed a policeman to make this monetary union work. And the second thing that's missing, and I'm sure Jörg Rocholl will talk about it, is the banking union. You cannot go to a monetary union without having banks follow the same rules, have the same rules for being unwound, and the same rules for ensuring deposits and ensuring that banks behave properly and don't invest in bad assets, and have a unified system of rating agencies, et cetera. This just wasn't done. So all these things, and we also, we just didn't really think hard about bailing out, and now we have these ex-post bailouts that Hans-Werner talked about. So, poorly planned at the outset, and now we're halfway across the river, and I've had this discussion with him before. It's like trying to swim across the Mississippi River, and you're a good swimmer, and you've got a life jacket on, so you should make it, but the Mississippi is an incredibly fast-flowing river with all sorts of, torrents and undercurrents, and you can just get sucked in there and you never come up again. Well, if you're halfway across the Mississippi River, you don't say, I'm tired, I think I'm going to go back and try again. You just have to get through with it. So it's incumbent on Europe now to sort of pull up its pants and try to fix this thing, because not fixing it is a very, very bad alternative. And in the last minute, I'd just like to say why I think it's a terrible alternative, even now. Because personally, I'm optimistic. I think Spain is turning the corner. I think Ireland already has turned the corner. We've seen really strong signals that the German economy is going to grow fast in the future. The DAX just burst over 9,000. The orders look good. What Germany needs to do is grow a little faster than these countries that have been shrinking. Greece has shrunk 25% in the past 4 years. We've gone this far. Let's reap the fruits now. Let's make this thing work. And I think we need to think hard about that. I think it's not a good idea to focus on legalistic problems. I do realize that the commitment. The commitment to buy debt on the open market has not really been made, has not been executed yet. It's just a commitment, and that's already had an effect on the markets. I think it is a problem if nations start to throw any sort of due diligence to the wind and start running deficits, but I don't see that actually. I see Southern European countries struggling, imposing incredible austerity programs on their population to meet the diktat of Berlin and Brussels. So we should at least give them a chance. And the next time around, let's design a system that actually works. And that's the challenge for the European community, because I think Europe has a lot to lose by giving up the euro, and we'll discuss later. I think if one of these countries falters, it'll be a disaster. You won't see it immediately, but it's like pulling one brick out of a wall and eventually watching the whole wall fall down. It won't happen immediately, it'll happen over time, but it'll be the last bit of commitment that the Europeans can have to some sort of unified trading area. So I think I'll stop right there.
Thank you, Michael. Jörg?
Yeah, thank you, Paul. Speaking after two highly distinguished economists, macroeconomists, let me now take more a financial perspective on what's happening. And let me start by first thinking of what are the elements that are actually crucial for the ECB. And I would see there are at least three key elements. The first one is the question that was, the point that was mentioned already on the securities market program or any security purchase that the ECB can do, either in the earlier version or in the commitment that we have now. Number two is the way in which the ECB provides liquidity to banks against certain types of securities. I'll come back to the quality of these securities. And the third point that is now currently being discussed very intensely is a question of how can the banking union be designed that actually really fulfills its purpose and is not just another way of transferring money from one country to the other. When we look at the banks going into this crisis as basically one element, then the banks, basically you can figure out two elements. One is that banks are highly overly exposed to sovereign debt. So when you look at the stress tests, banks in the peripheral countries hold a multiple of their equity in government debt of their country. And this has to do with the fact that the regulation is just missing, that sovereign debt is treated completely differently from the exposure a bank, for example, would have towards a corporate client, towards a corporate bond, and so on. But this means immediately, if a country gets into trouble, then also the bank gets into trouble because a write-off is necessary, therefore the equity could be wiped out right away. The second part is that banks are overly exposed to the real estate cycle, in particular when we look at the situation in Spain and Ireland. So in that sense, there was an overly optimistic assessment of what the real estate market would do. Thus, banks invested, gave mortgages in this sector. Once the bubble burst, there was the direct consequence that banks couldn't, at least had a severe liquidity, in my opinion, often a severe solvency question. The direct consequence was that the interbank lending market in many countries really stopped working. So there was no interbank lending anymore in many of the countries. And now, what would be the natural consequence in a market economy? What should be the natural consequence in a market economy? It should be a resolution of those banks that just can't be in the market anymore, and they should just be taken out of the market. Unfortunately, this is not what happened. What really happened is, and there are different studies and several examples of this, is that bailout was the rule and bail-in was the really very rare exception. Bail-in never really happened, so it was rather the taxpayers had to pay for what these banks did. So this was number one. And the second part is that, and this comes back to the second element I mentioned on the ECB, that many of these banks just couldn't survive anymore without the financial support of the ECB. So the ECB had to step in, had to lend money to these banks, often at against very questionable securities, and had to provide liquidity to these banks. So in that sense, when we think back of this crucial question that both other panelists mentioned, when we think back of this very crucial question of bailout versus bail-in, then also on the bank level, we can just say bail-in never really happened. It wasn't credible, it never really happened. Bailout was the norm, and it was helped also by the way the ECB provided the financing. So what is the conclusion out of this? Obviously, this can't go on. So this means it is not sustainable to continue living in a system in which bailout is the norm and bail-in doesn't happen. Maybe looking a little bit now at the banking union, and then of course also thinking very carefully about what the ECB does here. We are now confronted with different steps within the banking union. The first one is, that is the one that is probably most complete, is the single supervisory mechanism, the SSM. And there have been made many arguments against why this single supervisory mechanism or the supervisory function should be with the ECB. Just to mention a couple of the arguments from the Larosière report, their experts were concerned that if you put the banking supervision to the ECB, the independence of the ECB might be threatened. It might arise in a conflict of interests. And this is something we read now basically on a daily basis, that also there may be conflicts of interests. There might be a lack of operational expertise within the ECB to really conduct the supervision. The second part, and this is now in my view the absolutely crucial part in going forward, is the second, also now heavily discussed directive, the so-called Resolution and Recovery Directive, RRD, in which there are elements of a bail-in for the first time really discussed. Unfortunately, only to be implemented by 2018, and also under rather vague exceptions that can be taken. This, in my view, would be a very important element in order to come back to a regime in which bail-in is credible, is efficient, in order to protect taxpayers, and in particular also to make sure that there will never be a situation again in which the ECB has to step in to provide liquidity to banks. And then finally, this is maybe just as a side note, because it not, at this point of time at least, has a direct link to the ECB, is this what is now being discussed as a single resolution mechanism. So the question of how and where should a resolution fund be designed and located that could actually help banks that even after taking into account all the bail-in, all the creditor participation, how all these banks can be secured and how they can receive money. And there are lots of questions, again, about incentives that need to be taken into account, meaning that countries should have no incentive to basically just even start thinking about moving burdens, legacy assets that have arisen in their systems to the European level. So in short, I would argue, and of course, as Paul said, my research is coming from the field of financial economics, we have to deal very carefully with this banking union, with the way financial intermediation works, and in particular to not forget, with all the other questions, the banking union and the question of how liquidity is given to the banks in the ECB open market operations.
Thank you. I think we got a number of interesting aspects and sort of slight differences between the speakers. I noticed that only the first speaker thought we had beyond the real crisis and competitiveness in between the different areas and the sovereign debt, a private debt crisis, while the other two termed the private debt crisis a banking crisis.
That's the same.
My first question, is that exactly the same? Or are the second two, so you would argue it's the same, so that's interesting. That cleans up my first confusion, perhaps. But is it really the same? So let me follow this up. So we are now setting up again a system for the future, and I guess it's important that we have credible commitment to the bail-in, by which I guess is the idea that people owning the banks, maybe the private creditors, are the ones who are going to bail out, the ones who are going to take the losses. Now, the no bailout clause failed miserably in the past in the Maastricht treatment. If we ignore this, if it's a legalistic issue in Michael's work, what would make me believe that in the next crisis, when a bank gets into severe problems, and presumably if a bank in a particular country, let's say in Germany, the Deutsche Bank, gets into severe problems, it's Germany that's especially hit and has a particular big interest in finding, again, a fuzzy solution. So how credible is it now to come up with a system that doesn't face the same problems we're criticizing right now on the Maastricht in the banking area? Is the idea that we're waiting to 2018 only, that we already have a bunch of debt that we have to move back and forth, or which is, may be good or bad, or is it a permanent problem? Is it at all feasible for us to set up a credible resolution mechanism for banks? So this was one of the big things I was wondering about, and so maybe we start with that, and then in the second round, let's see whether the fact that we have these austerity measures and I guess youth unemployment rates that are mind-boggling in some of the southern states, is that just sort of on the forefront of a big success story that we just have to keep cool, and in 2 or 3 years we'll get the big success? Or is that not just a sign that the current policies are not working? But I think I would like to first hear about, is there at all a chance to have a credible resolution mechanism for the banks if we didn't manage it for the states?
Yeah, I agree to the implicit answer to your question, which you gave already.
I didn't want to give an implicit answer. Okay,
that we have to let the banks go bankrupt in the sense that the creditors accept debt equity swaps and bring in the equity to recapitalize the banks. The debt of the banks of the 6 crisis countries is 9,000 billion euros. It's nearly 3 times as large as the government debt of these countries. So the idea that the taxpayers would be able to shoulder the losses, I find absurd. The potential losses are so huge that there is only one group in society which I can see which has the wealth to bear these losses, and that is the investors in these banks. Exactly the people who gave the money to the banks, period. Sorry, if you made a mistake, if you have too much money and don't care whom you lent your money, you have to suffer from the loss. And there's all the possibility to revitalize these banks by converting the debt. Let me say something more fundamental to understand where we are. I think we had 3 waves of the euro. The first wave was this excessive capital flow from Germany via France and Benelux to Southern Europe. That happened because the no bailout clause was not taken serious. And here I agree with you and you about saying that it was badly done. There was no policeman, there was no equity capital required for the banks when they were loading their balance sheets with government bonds. So the actual procedures in the Eurozone violated already the Maastricht Treaty and the no bailout clause, and therefore the investors could go to Southern Europe without care. There won't be a problem. The no bailout clause will never materialize. Had they taken that serious, they would never have gone, because the treaty says, well, if you go to Greece, you will have to suffer from the loss because no one bails you out. That's what the Maastricht Treaty says. If they had believed that, they would never have gone. But they didn't believe it because the actual regulation undermined the Maastricht Treaty from the first moment. And so we had these excessive capital flows, creating a credit bubble in Southern Europe, which financed wage increases way beyond the productivity increases, inflated these economies, and deprived them of their competitiveness. They are all too expensive nowadays. They have to devalue by 30% or so, Greece, Portugal, Spain, in order to become competitive. And that is the fundamental problem. So we wrote something into the Maastricht Treaty. We did not respect it on the way. So I don't believe anything which is written into any treaty in Europe unless it's done. And it doesn't help me a lot or at all if one says, well, now we do the bailout, but from 2018 onwards we will do the bail-in. We will never do that. So the only way to create credibility is to respect the Maastricht Treaty, allow for the bankruptcies, and I believe for exits. The Eurozone, in my opinion, is not viable. I think we should try to preserve the Euro, but I don't think we can do that with all countries. If we try it, the whole thing will collapse in a big clash, and the European idea will have gone, even the EU will be destroyed in the end. I find this process, which I see very, very, very dangerous. So the only possibility, in my opinion, is we do a real alignment, a reset of the Eurozone, and allow some southern countries to exit. To exit, have their own currency, devalue, become competitive, having lower exchange rate, and then at a later point in time, gradually they might be willing to re-enter at a new exchange rate. This is a lot of turmoil. No illusion, we would have to resort to Cyprus solutions with capital controls when we do that. But once they have exited and we have depreciated, then we can lift all the capital controls because there are no losses any further. The capital would actually be willing to return. This is, in my opinion, the only solution to repair and rescue the euro, which I think is useful to do. I don't think Germany should exit. I don't think we should draw a borderline between France and Germany. I don't think Italy should exit, but I do think that Greece and Portugal have to exit, and possibly Spain, because their realignment need is so large that they will probably not be able to make it. In Spain's case, I'm a little bit insecure. With Portugal and Greece, I feel pretty secure.
Okay, so let me move on to Michael now. We're slipping into the second, perhaps more tempting and more interesting question already, but let me first say, is there any chance of a credible banking regulation given that we messed up so badly in Maastricht?
I would like to talk about Hans-Werner's other point about exiting.
So,
but I'm going to pinch myself. And
just,
I'm not going to do
wait,
it.
and I'll promise you get.
I'm not going to talk. I'm going to talk about banks. I really like because I think banks are. This is another. It's a complete blind side. That the Maastricht Treaty was completely blind to the fact that banks are such an important part of our lives, and now shadow banks are even more important. We don't know how important shadow banks are because we don't even know how big they are, but they're so important. And they, if we can't factor them into this problem, then we're never going to solve the euro. So the banking union, to me, is has the highest priority right now. And in terms of establishing credibility, I have to look back to my own home country, the United States of America. Every year, 100 banks fail in the United States, and you can see it on the website of the Federal Deposit Insurance Corporation. Okay? 100 banks. Now, America is a big country. There are lots of banks. Europe is a big non-country with lots of big banks, but banks do not fail in Europe. They get bailed out by the government, or they get taken over with bailout help from the government. And that's just not a very good way to do business. And why is that? The reason why is because depositors are the hostage of the bank's management and the bank's owners. Okay? So the reason why banks can get bailed out in Europe is because they threaten with a complete catastrophe, and all of you will lose your bank deposits. We all need our money for our transactions that we conduct. Companies need transactions balances. But the owners of the banks and the big investors in unsecured and secured loans to banks know that governments don't have the guts to let banks go down and just bail out the depositors up to 100,000 euros or 150,000 euros. And that's why they get away with this every time. So you need to move to an FDIC model where there's a clear insurance fund, banks pay in, and high-risk banks have to pay more. So I have no problem with Italian banks and Spanish banks and Greek banks paying much higher premia than German banks. But let's do it right. Let's do it actuarially fairly based on the risk of a bank run, and then insure your deposits up to 150,000. If you have more than 150,000 in a bank, you are the dummy. And you should be investing in real estate, or you should be investing in the stock market, or not in bank equity, because that's risky. Of course, as soon as we do that, we're changing the rules of the game, and a lot of people who have stocks in banks are going to lose money. And we're all scared of scaring them away, right? Well, listen, folks, we're going to have to go there somewhere. We're going to have to go there some way in the next 10 years or the next 15 or 20 years. And Jörg himself said they're already fudging on 2018. But we have to move to a regime where banking is a business like every other. It can go bad. Okay? And to me, once you do that, you can make it credible to shut down a bank. Because people like you will not vote politicians out of office because you lost your deposits. That's the secret. So let's move to a serious system of European deposit insurance, another big failure of the Maastricht Treaty. Hello, banking union, where is the deposit insurance? Well, every country wants to have their own national deposit insurance. This is not going to work in an integrated European world. I'm sorry, it's just not going to work. How do you close down UniCredit? Look at that bank. It's all over the place. It's in Germany, right? And there are a lot of Germans who have bank deposits there, and there are a lot of people who have invested in UniCredit, senior bonds, and how you treat those guys. We need to sort this out very quickly. And of course, there's going to be a lot of bankers who are mad at me and mad at people like me for talking about this, but this is the only solution. That's going to get credibility in terms of getting banks that are failable.
HVB is a separate bank if it belongs to UniCredit, but if UniCredit defaults, this doesn't mean that HVB defaults or that deposits of the HVB are under risk.
Well, you can ask the banking expert. He'll tell you, yes, it is.
No.
Because people just take their money out, Hans-Werner. It's what causes a bank's instability in the first place. You cannot prevent people.
Still, the losses of the UniCredit cannot be transferred to HVB. So these are, even though they are in one holding, there are liability barriers between them.
Jörg.
Maybe I'll start with the latter. So I agree that the losses can't be taken over. Still, I mean, what they of course do is take away lots of the profits. So basically taking away lots of the opportunities for that bank to grow. But maybe put it on a more general level. So I just read this afternoon that there's a study that came out today that the amount of non-performing loans in the Eurozone increased by 15% within a year. And this amounts to about 120 billion euros. And now it is at about 940 billion euros overall. So the amount of non-performing loans. Now coming back to Paul's question, when you said, is private debt, can the private debt crisis be associated with the banking crisis? I think this by itself is not really the problem. The real problem is if a banking crisis or say a private debt crisis immediately is a conditional liability for the government. So this means if a bank is, or say a banking system is able to somehow be robust enough to filter out or to provide a buffer against private debt, then it's fine. The problem really is that what happens if this private debt accumulates, banks made unwise decisions in lending, and now all of a sudden their problems really become the problems of the states. And maybe to just give one piece of evidence on that. When you talk to rating agencies, they tell you basically one thing. It's very easy in the end to figure out a rating for a corporate bond. So you basically just have to look at two factors. One is the capital structure of a company. Second, it's the coverage ratio. So basically how much free cash flow you have in order to serve your debt, interest payments. For countries, they haven't found any factor that is nearly as important as those that they found for the corporates. And this has to do with the fact that they have no understanding really. They are quite open on this. They have no understanding really on what actually makes the private sector influence the public sector. So they know the private sector is extremely important to understand the functioning or the solvency of the public sector, but no one really knows which are the factors that really make it work. In my view, one is clearly this question of the bail-in, the question of how much debt can be taken, can be absorbed within the system. And I have to say I'm quite skeptical yet on the proposals that have been made. One criticism was that it only becomes effective in 2018, but there's actually more on this. So even when you now read, for example, the letter by ECB President Draghi written to the Commissioner Almunia, and still asking for, could it be possible to rather use some exceptions and not really start it right away? It always comes back then to this argument of contagion. So we have contagion, we can't risk this, but this argument can be used from now until basically infinity, and it will not really...
And the contagion argument actually, even if there's a firewall between a bank that's owned by a common holding between Germany and Italy, you know, people in Germany are going to get nervous and take their deposits out, and that's enough to cause a failure of a bank. Because they're inherently unstable institutions.
That I agree with, but let's say I see the risk there, but what I'm actually even more concerned about is the fact that contagion can always be used as an argument. And this is what we now see, for example, in this RRD directive, that initially it had a very clear triggering schedule, a very clear cascade of things that should happen. Now there was some pressure from probably some of the peripheral countries saying, in principle we agree on bail-in, but we'd like to use the exception if contagion can appear. And now that by itself might be fine, but if you don't define really under which conditions contagion can appear, I think we will always be held hostage again of this contagion argument in the future. And this is my real concern.
Yeah, let me just add, before the haircut in Greece 1.5 years ago, which was the largest in history, basically that Greece is bankrupt, we all know. It was said that cannot be done because the private investors would be nervous, there would be a bank run, and there would be something. Nothing happened whatsoever.
Well, Cyprus happened.
Then came Cyprus. The world will fall apart if we let Laiki Bank go bankrupt. This cannot be. It needs to be bailed out. And indeed, the ECB had provided them for the full year 2012 lots of money out of the printing press to pay out the Russian oligarchs and the Greek rich people who had invested their money there. There was 1 year of tranquility. It cost an awful lot of money, half the GDP they spent, and nevertheless, Laiki Bank went bankrupt. So the expectation was there will be contagion, the world will fall apart if we do that. What happened? Nothing. Because the solution is very easy. You have capital controls. Capital controls are ugly. We certainly don't want to have capital controls. But if the alternative is that the taxpayer bails out the investors, I know what I would prefer, capital controls.
Okay. Michael, I promised you were allowed to also talk about the second part. So is there any reason to assume that things are actually moving forward with huge unemployment in some of the peripheral countries? Does Greece and Portugal have to leave the Eurozone to have any chance in getting their competitiveness up? Or are the social costs for these countries to stay in the Eurozone really too big?
Well, I think I'm going to buck the trend and be a sort of optimistic person. And I think the data, I looked at the data today. Greece has deflation right now. Prices are actually falling as we speak, and they're falling in Portugal. So a year ago, we were debating this, Hans-Werner, we were saying this, they're not going to fall, there's too much. People don't believe that they're going to have to take the heat. But, you know, wages, this is the average inflation rates. So some prices of some goods are actually falling by 20%, 5, 10, 20%. Some prices are still rising because they're raising taxes and stuff. So there's a really good chance this is going to work. I'm just very scared still of the alternative. So, you say maybe we should not be scared of contagion, but I see Greece leaving the monetary union leading to a huge depreciation, okay? That's the first thing. That would be very painful for everyone who's invested in Greece. So all of our insurance companies would lose a little bit of money, not much, because they've bought derivatives against it and all they're insured. The ECB would lose some money, of course, because they're the big holder of Greek debt right now. 3 years of pain, there'd be migration from Greece, it would be a disaster, unemployment would probably go up to 50%, but then Greece would recover. 3 or 4 years later, we'll have Iceland. If you looked at Iceland lately, things in Iceland are looking pretty good. There's been some discomfort, a lot of people have lost a lot of money, but after 3 or 4 years, Martin Feldstein has said this, the real depreciation will have an effect. And that will not go unnoticed in other countries. It will not go unnoticed in Portugal. So if Portugal hasn't exited, they will do so. And the bigger countries will also exit. So the whole thing comes unraveled. It's like a sweater. You take one of those yarn threads out, and the whole thing just falls apart on your back. And I think that's what we don't want to have happen, because the euro is too valuable for this country. This country has built up a huge industry, maybe in a distorted sense. Maybe the exchange rate was too low all these years. Maybe Germany has had too much of a good thing from having the euro. But in some sense, the Germans have been able to reduce unemployment, partially because of the reforms. The reforms were brought about because of the competitive pressure of the euro. The euro really showed the German industry how expensive their labor was. So they pushed for reforms, and they got them from an SPD government. I think Germany can be happy to have the euro. And I think if we're smart, we can use that to convince the Spaniards and the Italians to reform their labor markets, because it is possible. So, I'm not ready to give it up yet. Hans-Werner is ready to give up the ship with Greece and Portugal, and I think we should try to float these are small countries. Greece is 2% of EU GDP. Who cares, right? But if it causes 20% of the EU GDP to leave the euro, then I care. If it causes France to leave, because France suddenly realized, hey, they're non-competitive too. They need a Schröder, and they still haven't got one yet. So let's put the heat to the French and have them reform their labor markets.
I don't think the reform of the labor market will do the job. Theoretically, yes, we agree in principle. These countries need a devaluation, and you can either get it through cutting your wages and prices within the euro, or exiting and depreciation, open depreciation. The problem is, though, an internal depreciation is very difficult for countries that have come into this situation of being overpriced through a credit bubble, because then the households and firms are over-indebted by definition. They have to service their debt, and if you cut their wages by 20% or so, then they can't do that. So you create a wave of bankruptcies inside these countries. It would be easier if there was just the labor market problem, the unions. That would be hard enough to fight against the unions and bring the wages down. But this debt problem is really a problem which, the internal debt problem, it's not foreign debt necessarily, it's internal debt, which is unsustainable. We did not have that in the Baltics, by the way. So the Baltics could easily cut their wages by 20, 30% and become competitive, because they had a different problem from the southern European countries. They did not have the credit bubble, so we didn't have private households and firms being over-indebted. But that's in southern Europe, the problems. So I don't think that is a feasibility. Here in this city, we have seen how terrible a process of real devaluation is. Germany in the Weimar Republic was forced to stick to the gold standard, while other countries exited from the gold standard. And Germany had lost its competitiveness because the others depreciated, Britain in 1931, for example. And we could not, because the Dawson-Young plan, which followed the Versailles Treaty, forced Germany to make the reparation payments in undepreciated Reichsmarks. So what did we have to do? Austerity programs, the Brüning programs, which resulted in a price cut of 22% from 1929 to 33, and a wage cut by about 28%. And the result was that Germany was driven to the brink of a civil war. The right-wing and the left-wing hordes were shooting one another in the German streets, and what came 33 was even worse, as you know, than a civil war. In other words, this real devaluation by cutting wages and prices is only possible to a limited extent, even in a society which has not much debt. But in Southern Europe, with these people who are over-indebted, I don't think it's really a possibility to the necessary extent. A little bit, yes. But if you believe in the respective calculations, then depreciation by 30% would be necessary for Greece, Portugal, and Spain. 30. This is enormous. My fantasy is simply not enough to imagine that that could happen. Wage cuts here and there, yes, government employees perhaps, but that's not yet the GDP deflator reduction. The GDP deflator, which is the end result of these wage cuts, went down in Greece by 2-3%. And actually during the crisis, the first 3 years of the crisis, it increased faster than in the rest of the Eurozone. So there is very tiny depreciation up to now, according to the data which we have, relative to the depreciation which would be necessary. And on the way, if you force them to do it in the Eurozone, you destroy this society. 2/3 of the young people are unemployed. 27% is the overall rate of unemployment. The Euro has driven these countries into a trap. It's a catastrophe, and I wonder how long we want to continue with this, sacrificing an entire generation of young people who have no chance to return to the labor market by following this policy. I find this, in fact, I find it outrageous that the policymakers, just for an idea, and actually because of the financial markets, because the investors want to have their money back, don't want to go this way towards competitiveness.
So I guess Michael was going to protect the German investors who have a lot of their wealth in Southern Europe, if I understood correctly. Well, Hans-Werner Sinn seems to suggest we should also look a little bit at the youth in these countries. What can the ECB do about this? I mean, one solution to, if you don't want depreciation, I guess, would be inflation in some of the other areas, perhaps even high inflation in Germany. A few years of 5-10%. Surely not a great solution, but a solution that we've had in the past. Would that be a way out, or what can the ECB do anything, and if so, what should it do?
Well, if the dollar were to appreciate, that would help a lot. As Hans-Werner Sinn sort of turned it on its head, if the dollar depreciates, that's going to hurt, especially the southern countries, because they have some markets in South America and the United States that would get hit. I see it differently. I see the U.S. economy picking up. I mean, they've had this problem with the budget, but I think that's behind us. I think the Republicans are on the defensive now. I see an expansion of the U.S. economy, a rise in interest rates in the United States, tapering, and that's going to cause the euro to weaken, and that'd be one saving grace. Now, of course, the European Central Bank can't accelerate that. I mean, I don't think they really can. I mean, they're already opening, as we've heard, opening the printing press for every possible application. So I don't think that's going to happen. But I think if we're lucky, the American economy will pick up. I also think the rebalancing is a little bit, Hans-Werner's point is correct. If you just take a partial analysis, a 30% depreciation of the Greek real drachma, of the real purchasing power of the Greek CPI or the GDP deflator would have to occur. But that's not the only mechanism. I mean, I think that the Greek slowdown has caused a lot of unemployment, like we know. The people who are still working in Greece are very productive. So, you know, they've gone through this sort of Schumpeterian creative destruction. The overmanning in Greek enterprises has been reduced dramatically. So the people who are still working are quite productive. Unit labor costs are falling. I have the data on that. Significantly, and that means that what they're still producing is actually competitive. So now the question is, can Germany and other countries in the world buy more of their stuff? So that's going to require some marketing, maybe some German know-how, a few machine tools from this country, and they can package those olives instead of sending them to Italy like they do right now. So there are a lot of things that the Greeks have to do, but I'm not so pessimistic. I mean, Ireland, people called Ireland in 1990 the sick man of Europe, and in 2007, before the financial crisis hit, it was actually richer, 30% richer on a GDP per capita basis than France. And of course, the crisis set them back a few percentage points, but they're still richer or more productive than the French economy right now. And that's a miracle in itself. So the Irish did it with 5 million people. The Greek could probably do it with 11 million. You know, let's just give them a chance.
The difference is the Irish were poor and underpriced, and the Greek are poor,
rich and
overpriced. Going up is easy, going down is impossible. That is the problem. This asymmetry in price changes, downward rigidity of prices, which Keynes described in his letter to Churchill, which, I mean, you have taught, we all have taught for decades. No? This is a fact. You cannot easily overcome it. Let me say one thing about the unit labor costs. I don't think they are a useful indicator because the way they are measured is wrong. You have to measure unit labor costs given the employment, but the employment is not given. There's a lot of unemployment. More unemployment means you wipe out the less productive firms, the less productive jobs first, meaning that the remainder that survives, by definition, has a higher productivity. So you increase the productivity by just going into unemployment, and that reduces your unit labor cost because it's the wage per hour divided by the productivity. If I have a heap of potatoes, and if I take the light potatoes out, then the average weight of the potatoes goes up. That is true, but I cannot buy anything for it. We had the same phenomenon in Germany. I know that very well, the Schröder reforms. I was myself writing a lot at the time about these reforms. And the situation was German wages were too high. We had the highest industrial wages per hour in the whole world. The capital was leaving the country to going to Eastern Europe, to North America, to Southern Europe, elsewhere. But we had the lowest rate of net investment in the whole OECD world here in Germany. And the argument was we need a low wage sector. We have to have wage restraint in Germany to make the labor market more competitive. And then the union said, well, it's not necessary. You see that our unit labor costs are already coming down. The only reason why they were coming down was the increasing unemployment. So we went through all these debates already in Germany at the time. It all repeats itself in Europe. What we have to look at is the prices. Unit labor cost reductions help improving the competitiveness only to the extent that they actually reduce the goods prices. All reforms, all infrastructure projects, everything which is discussed in the public helps only to the extent that it really reduces the goods prices in these countries. It would, because it would increase the productivity, and given the wages, you would reduce the prices. But if it doesn't reduce the prices, it's useless.
So how about inflation? High
yes,
inflation in Northern Europe?
I do think we need a little bit of everything. We need a little bit of inflation in Germany. We need a little bit of deflation in the southern countries, or even, or if only disinflation, stopping inflating. That will help. But how much would Germany, just a thought experiment, have to inflate in order to make Spain and the other southern countries competitive without cutting their prices? According to the Goldman Sachs study, it would be a price increase of 71%, which means 5.5% inflation for 10 years. Then Spain is competitive.
We don't believe everything Goldman Sachs says, right?
Well, these are. I think these are useful. These are useful studies. I think this is the most serious study. They update it every year. I followed them every year. I think this is not cheap stuff. And we did, by the way, ourselves in the European Economic Advisory Group some calculations, and I know how difficult it is to come up with reasonable numbers. So I think this is serious. This inflation is not allowed because the ECB has to keep the prices constant. That would require a change in the Maastricht Treaty. This inflation, even if the ECB wanted to do it, violating the Maastricht Treaty cannot easily be enacted, because even if you pump money into the economy, if you are in the liquidity trap, interest rates are close to zero, you cannot get the economy going by just pumping money into it. So I don't see this solution. So if it was available, yes, I would close my eyes, let's have some inflation. But I don't think so. In the moment, we don't see it. Italy, for example, is inflating as much as Germany throughout the crisis, even more. So where is the process of real devaluation? I don't see it. And it is not happening because lots of money is being made available by the ECB and the rescue operations. And as long as this money flows with whatever conditionality you wish, nothing will really happen of the reforms kind which you rightly mention are necessary to make the wages downward flexible. This is all a dream. Europe is not constructed in a way that these harsh things would happen.
Jörg, is the ECB so powerless? Europe just a dream?
Well, let me think of another very important aspect that actually directly relates to this, which is the question, so basically what do we find? We find in Spain, for example, a generation of, in particular young men, and that probably holds for any banking crisis or real estate crisis throughout history, a generation of young men that actually just chose the wrong way of using their human capital. So they went into the real estate sector. Now the real estate sector isn't productive anymore, trying to look very carefully for something else. Now the question is, for this something else to happen, we need to have a functioning financial sector. So a financial sector that actually would channel capital to those uses that are most efficient, in which you can really create growth, in which you can create employment. Now, the problem is that the banking sector in many of these countries basically doesn't exist anymore. So we have now this, it's basically a buzzword, but still I think there's some truth to it. We have this zombification of the banking sector. So, and the zombification, and this now exactly comes back to this point, the zombification is also helped by the fact that many of the banks didn't actually really have to go through all the restructuring that was needed, because they had still the ample liquidity that comes in from the ECB. So in that sense, going forward, if we take now, for example, a look at this asset quality review that the ECB undertakes, it might be the most important part is to really restore as quickly as possible the banking sector, to the extent that this banking sector then can also provide again the financing to small, medium-sized enterprises, which, according to all the estimates we can see, really have to suffer in those countries, while they don't have to suffer basically in the core, as in Germany. And this seems to be such a fundamental requirement that it's indeed the banks that are basically responsible for their own doings, that are making their decisions on lending, that will then also finally allow these companies to start growing again. The current policy looks quite challenging from a general one-size-fits-all approach, that at some point you really may have to think, even as a central bank, about very different strategies in different countries to deal with the different challenges that are out there.
And does the ECB have the tools to get rid of the zombie banks?
It would certainly have. The question is whether it's desired. If the ECB took seriously the question of only to allow financing to banks that have high-quality securities, it would actually be a pretty, it must have been, should have been very strict. Now, one may understand that maybe there is some delay, or it takes some transition time, but we should not forget by just keeping these banks alive that there must be also policy actions being taken to really provide a functioning banking sector again.
Yeah, because there's capital tied up in those institutions that could be used in productive ways, right? There's a real risk of that. I mean, you pointed out this early on, that a lot of refinancing was done with dodgy bills of whatever, and even even using Greek government debt as collateral. It was already from the very beginning. So one thing I'd like to pitch for would be to reform the ECB, and we've talked about this before. One of the reasons why the ECB never imposed those collateral requirements or the differential haircuts is because it's a political thing. The Bank of Portugal is the filter for the rediscounting process. The Bank of Portugal actually owns the ECB, right? So the ECB, a Portuguese bank tenders some bill of or some bond as collateral for a rediscounting loan with the ECB through the Bank of Portugal. The Bank of Portugal is never going to say no to its own banks because this is a national issue. So my suggestion would be to get rid of the national central banks, including the Bundesbank. It hurts me to say that, but if you want to depoliticize the banking system, you've got to get rid of national boundaries. And it hurts me to say that because I like the Bundesbank. I've done a lot of stuff with the Bundesbank and I admire their research. But in the end, the national banks, Europeans are still hanging on to their national identity, but that's going to make it impossible to play hardball with every bank in every one of these countries. And that's something we have to deal with. I think even Hans-Werner agrees with me on that.
Yeah, I agree. What means, no, we don't differ very much.
Okay.
The problem is, first, the ECB, with its national central banks, was bailing out the private investors in Southern Europe. Now the ECB has taken their place and is a dominant creditor of the banks of Southern Europe. The banks of Southern Europe have foul claims against the real estate sector, against near bankrupt governments. So that means the ECB is under threat. The ECB falls when the banks fall. That's where we have arrived because of this excessive lending as measured by the target balances, by the way. And now we are in the third phase where the taxpayers through fiscal operations have to come in to bail out the banks, to bail out, in fact, the creditor of the banks, namely the ECB. No? So the ECB bailed out the private guys in the first place, and now we bail out as taxpayers the ECB. And that is a terrible process because we have hardly any alternative. Because if we don't bail out the ECB, then the whole thing collapses. Mrs. Merkel says there is no alternative. Tina, yeah? She is right. Why is there not an alternative? Because all the decisions have been made years ago by the ECB Council. The ECB Council gave this extra credit to the near bankrupt banks of Southern Europe, and it did so not only at the time of Lehman, but when the world economy was recovering in 2010 and was actually booming like hell. Even in that situation, they continued lending to these zombie banks in Southern Europe, and it is now part of the problem, and now the policymakers, the parliaments of Europe make decisions, but what can they do? Nothing. They just are vicarious agents of the ECB Council, who 3, 4, 5 years ago took all the decisions. It's a catastrophe for democracy too, because this council is not a democratic body. These are technocrats. They were not meant to make fiscal decisions. And they used the power of independence, misused it for bailout operations. That is the major problem. So we have to get at the ECB to stop this ECB Council continuing this policy. We need a democratic representation of the countries according to size. It's impossible that Malta has a seat and Germany has a seat. This is incredible. And then they make these decisions. It is incredible that the ECB has ELA credit, where 1/3 of the members of the ECB Council are enough to activate the local printing press without any limits. You know, 2/3 majority would be necessary to stop this ELA business, but the 6 crisis countries have already 8 out of 23 seats. So they have already more than 1/3. So there is no, they cannot be stopped. They can print as much money as they wish and buy the sky on earth. Yeah? No one stops them. And these are relationships which are very little known to the public, but which are, again, not tolerable.
I think I would like to open it for questions from the audience. Maybe there's the gentleman over there. You can wait for the microphone. Could you please just briefly introduce yourself with your name and then your question? Sure. Thank you.
Jasper Sky, New Economic Solutions Network. I'm wondering about this question of recapitalizing de facto insolvent banks that are simply not being recognized as such, the zombie bank issue here. They are insolvent, a lot of Spanish banks are insolvent because they overlent in the real estate market, they had a self-reinforcing spiral of increasing mortgage sizes. Now everybody in Spain is underwater, but in Spain you can't just walk away from your mortgage debt. It stays with you unless you declare personal bankruptcy, which I understand is very difficult in Spain. So what's really needed in Spain is for people who are unable to pay their debts back to get debt relief, to essentially write off at least part of their mortgage debt. And if that occurs, then these banks will have to recognize their insolvency. If that occurs, then there's a whole bunch of problems, right, with contagion also to other European banks. And then comes the question of recapitalization. The private sector might not want to recapitalize these banks. It would cost a lot of money. The current owners of these banks would have to recognize that their investments are gone or worthless. They have political influence. And if national governments were asked to turn around and recapitalize from taxpayers' money, it would be hundreds of billions of euros. And this is very difficult for politicians to be able to do when they're busy, cutting back kindergarten spending. So they don't want to do it. So the whole thing ends up in stasis, and the stasis includes the inability, exactly as you gentlemen pointed out, of any real credit to be available for legitimate business in Spain now. And also, there's the Richard Koo's famous balance sheet recession. People are indebted; they don't want to take on more debt anyway. So even if even if the banks were willing to lend, nobody's willing to borrow. So you have this conundrum. We need to write off that debt. We need to have a huge write-off of debt. How are we going to achieve that? And the question, I have actually two questions. The first question is, why don't we use the balance sheet of the ECB to recapitalize the banks instead of taxpayer money? That gets rid of the political problem. Why doesn't the ECB essentially buy equity in the banks rather than buying crappy bonds from these banks and recapitalize the banking system that way? And the secondary question is somewhat related. Professor Sinn is saying that a lot of countries should leave the Eurozone. He explains why he thinks that's the case. I totally agree with you, Professor Sinn, but what happens to the debt of the people or those countries if that debt, the sovereign debt, continues to be in euros, as well as a lot of the private debt there? What you're going to get is a depreciation of those local currencies if the drachma comes back or the peso comes back. If the debt is still in euros, then there's going to be a massive increase, essentially, in the debt and burdens of these people. So are you suggesting that the nominal debt be carried away in drachmas? Is it going to be one-to-one initially, drachma to euros, and then we let it happen afterwards so that the indebtedness decreases as well, the real indebtedness? Or what's your idea there? And as a corollary, Dr. Burda, I think that Dr. Sinn was making a good point when he was saying essentially that the reduction in the wages, if there's a 30% reduction in wages, there's also a reduction in the ability to repay debt. Mm-hmm. And you're getting people in, again, this balance sheet recession position even worse. There's a failure of aggregate demand, and you're going to get a downward spiral. So the idea of internal deflation just doesn't work. I agree with Dr. Sinn on that.
Okay, so I think you're getting sort of to the hard problem. Making it very short, there are some losses to be taken. Who should take them? Why not the ECB? And why not do it as we've seen in other banking crises, rather than just taking the debt, take equity in the banks if you're bailing them out anyhow?
Let me take your second question first. So what do we do with the external debt of these exiting countries? I would convert them into the domestic currency of that country so that the value goes down. It's an automatic haircut that takes place. But that being said, even if that would not be possible, I think the only way for the outside world of these countries to get some of their money back, the only chance is nevertheless a depreciation. Even though the debt-GDP ratio jumps up, a depreciation is necessary to make a positive current account, namely a positive cash flow with the rest of the world and repay something. So the path towards debt sustainability always goes via an increase in the debt-GDP ratio. And that could be done through an open depreciation or an internal depreciation, the foreign debt problem remains the same. But again, I would relieve that debt because I don't think even with a depreciation they will ever be able to repay. The internal debt problem, if one Greek owes money to another one in Greece, is also for the debtor a problem. If we cut the prices and wages in Greece, because the debtor will not find debt relief then and will be over-indebted. So that's the impossibility of cutting the wages and prices. While if they exit and depreciate, you rewrite all contracts within the country, and so the debtor automatically has relief. So I think there's every reason to prefer an open depreciation rather than an internal depreciation. Now comes the first question: why should we not resort to the ECB? And the ECB absorbs all these losses, provides equity, or takes or writes off the claims which it has against the banks, for example, through the refinancing operations. There were many possibilities to re-establish the equity, but then the losses would sit with the ECB, and I think it would be an illusion to believe that this would not be the taxpayers' losses. It is the taxpayers' losses, because any loss which the ECB makes profit by lending out the money it has created against interest. The present value of this profit under static calculations is equal to the monetary base, 1.3 billion euros. Under dynamic calculations, Willem Beuter has done this calculation, it's about 3 trillion. So 1.3 trillion and 3 trillion euros. If there are write-off losses for the ECB, that bites into these 3 trillion euros, which is the entitlement of the taxpayers of Europe to get the profits from the ECB. And there is a one-to-one loss. There is not a possibility of just shifting losses to the ECB and say, hey, the taxpayer is not affected. He will bear these losses one-to-one, cent by cent. There is no divine mechanism here which allows us to shift the losses of society to the moon or somewhere. It is not possible. No?
I actually it's a recapitalization of the commercial banks using the ECB's balance sheet, not by giving them gifts.
Yeah, but they are undercapitalized and they have losses. The typical bank has an...
Losses should be absorbed by the people who own the banks now and their creditors.
But it's not enough. Come on, this is by no means enough. A normal bank in the Eurozone has an equity of 2-3%. The Deutsche Bank, for example, has less than 2% equity in the balance sheet. This is nothing. So,
I said the owners and the creditors.
yeah, but I think the answer to your question is that the equity of the ECB, as it stands, is not big enough to take over banks. It would have to be a nationalization. So you're proposing basically that the ECB just act as an agent of nationalization and just take an equity stake in all the banks and then basically share in the profits and losses. And what he's saying is...
We sell it to the private sector after you
no. Either there are losses or not. So if the losses are bigger than the equity capital, it doesn't help making the ECB the owner of these companies. They provide new equity. They would be bearing the losses. Or would you say we have a combination? The ECB gets the equity, recapitalizes the banks, and in addition we have a bail-in of the private creditors.
One more point on this. I actually think it will be a complete nightmare when we think of the banking union going forward. So think of the following situation. The ECB has a stake in a bank. At the same time, the ECB is a supervisor for this bank. And now the ECB thinks, this bank actually, shall we now close it down or not? Say, if from a supervision perspective, it thinks actually this could make sense, but then it talks to its auditors or those who want to preserve its balance sheet, and they say, sorry, it doesn't make sense because we want to preserve the value. It will create tremendous conflicts of interest that I don't.
Right. I'm not suggesting that they keep these things. I'm suggesting that you recapitalize them and resell them a week later to the private sector after you've got the crap debt off the books.
But why not, but if this is possible, why not immediately ask the private sector to recapitalize? I mean, if they, so let's say the one thing that I see is the following, that why not, so let's say if we think about how to deal with these banks, then I think it's all too often that we think of bad banks and so on. The equity participation of someone coming in from outside after everything has been written off and all types of bail-in have taken place is a good thing, because then at least you can also participate on the upside and not just basically take the downside, or basically the maximum you would get back is the nominal value, but with some potential of fearing the downside.
Yeah, the private sector doesn't want to recapitalize these banks, right? It's like, it's an admission that your stuff is worthless. So the solution is the Swedish solution. If you really think the situation is as bad as you think it is, let the government just take it over, kick the management out, reduce the equity of all the owners to zero and start from scratch, and then resell it, just like we did in the United States with Chrysler, right? That's the way to, or General Motors, that's the way to do it. Right. But that isn't politically impossible.
And it would not be the function of the ECB, because this is a purely fiscal operation. And the ECB is not allowed to carry out fiscal operations.
I think
we have to rewrite the Maastricht Treaty. After all, the rule of law somehow has to be respected with all these things.
Okay. I think the next.
Yes, I would like to follow up on this idea that there is a risk if the ECB obtains a stake in the bank and at the same time the regulator. Now, but this has happened already. I mean, whether you have a formal equity stake or whether you have borrowed, given money to a bank which is essentially not able to repay it, the ECB de facto has a stake in all these banks, and that's what I think the point has been made already by Professor Sinn, that we are already in this game, that the ECB de facto is at least partially the residual claimant on these banks' income. And in this sense, it owns them, although it does not legally own them and cannot really directly operate the bank system. So this is, we basically create, in terms of incentive structure, an extremely bad situation. And I mean, these losses are out there, and I think the attempt to delay basically putting these losses onto somebody's shoulders, and the repeated attempts to eventually put it on the taxpayers' shoulders, they have completely distorted and messed up the incentive system in our banking system and the banking supervisory system, and I don't see actually that the current proposals propose a way out of this.
So maybe just one point on this. I agree with this. This is when I said in my opening remarks that, for example, the Larosière report, which was really one of the most important assessments by the European Commission to figure out what are actually the lessons we can learn from the financial crisis, made it very clear that the banking supervision should not be, say the micro-prudential supervision should not be with the ECB. Now, one can argue that maybe last year in the summer when this decision was made, no other institution was really available that could be used right away. But I think even in the ECB's self-interest, they rather should try as soon as possible to outsource the banking supervision somewhere else and take it out of their operation just because of these conflicts of interest.
Yeah, but the reason why they want to do it is because they are the biggest creditor of the banks.
Right. Right.
I think there is another question over there first.
Yeah, that's good.
Sorry.
My name is Tausif, and I'm currently doing my MBA over here. So there was a discussion about exclusion of some countries like Portugal and Greece from the Eurozone. So I think this might have a positive impact on Euro in the short term, but I think in the long run it can have negative social impacts. For example, it can further contract the economies of this country, and then it can increase unemployment. So I think this can have negative spillover effects for the neighboring countries, maybe like France or other countries. So do you think that like European Union can manage such negative spillover effects from these countries which are excluded from the Eurozone?
Well, there are negative and positive spillover effects, all kinds of spillover effects. To be frank, the strongest spillover effects, which I fear, is if we promise Greece to stay in, they can do what they want. They can borrow more and more at the expense of the taxpayers of the other countries. And if Greece does that, then there's a spillover effect to Portugal, and Portugal does that too. And if Portugal does it, Spain does it. And if Spain does it, Italy does it. So we get stuck in a debt spiral which will end in a catastrophe. We have to have a system of hard budget constraints. A market economy cannot exist with soft budget constraints. Janos Kornai and others have written about that. And as painful as it is in the moment, it is necessary. I don't say that there are no situations in the world where Keynesian softening of budget constraints can be temporarily useful. Yes, I agree there are. But we cannot do the Keynesian trick year after year after year. These are painkillers. And if you are sick, you cannot always take a painkiller. At some stage, you have to go to surgery. And this is where we are in the Eurozone. This is, the crisis began in 2007 in the summer. Now we have, we are 6 years ahead of that. We have had more than 6 years of crisis. So for how long do we want to go the painkiller strategy because we are afraid of some contagion effects?
But I think the pain is subsiding, okay? I have to argue with her. I think we've had enough painkiller that it's actually working. I looked at the target balances today, okay? They peaked at 760 billion euros. This is the German, the Bundesbank target balance with the rest of the European Monetary Union. 760 billion. They're now 570. Okay, so they have gone down. They've gone down for a whole year plus 2 months now. So the trend is definitely down. And if Germany continues to grow a little faster than Greece, and Germans will import a few more olives than the Greeks are importing Porsches, then eventually the target balance, this gift that you talk about, will eventually disappear. And maybe the Greeks will run a surplus with Germany. You know, it's possible. The problem is we don't have a policeman to make sure that banks don't evade the budget constraint. That's the problem. The reason from the very beginning is that we had bad collateral requirements and private banks in the South could just have a party, and we're still paying for that party today.
Is it a good sign that the target saldos are decreasing?
No, I think it's just a repackaging, basically.
You can't change the story.
It's the OMT. It's the OMT, which to a large extent is responsible for private capital daring again to go back to Southern Europe. It's not
but no
economic success.
No bonds have been purchased yet. OMT is just a threat. They haven't bought any bonds yet.
No, but it's a free of charge insurance, a credit default swap insurance for investors who go to Southern Europe, because Draghi has told them, if you buy Spanish government bonds and you're afraid, you don't have to be afraid that Spain goes bankrupt before they go bankrupt, you can come to me and I buy them from you and absorb all the write-off losses in my balance sheet.
Yeah, but as long as Spain does their homework, the guarantee stands. It's not an unconditional guarantee.
Yeah, but this is, well, you know as well as I do that an insurance contract has its value, its economic value, even before the loss has occurred. You can buy the same insurance which Draghi offers free of charge in the market as a CDS insurance against the default of the country whose assets you buy, and then you would see that the OMT has an annual value of 60 billion euros. So that's the free of charge insurance one provides. So anyway, concerning target, this insurance means that the investors of the North are willing to go to Southern Europe, so they make money orders from the North to the South. That reduces target 1-to-1. That is obviously the OMT. And in the case of Greece, it's even more interesting. I looked into the figures. The reduction in the Greek target balances has only one reason. Not that private capital is being sent back to Greece, but only the reason is that the official rescue operations lend money to Greece. That means money is being ordered from Northern Europe through the ECB system to Greece, and this reduces the target balances 1-to-1. So in the Greek case, it's just a repackaging. The credit from the printing press is being replaced with the credit from northern states. You can believe me. So it's 1-to-1 in the case of Greece.
I mean, to me, the target balance is the credit. So the offsetting element is what's interesting. So to me, what that says is that the amount of exposure of the ECB is actually going down. So therefore, the Greeks are actually paying. The Greeks are actually receiving investment from Germany from private sources.
No.
But they have to be, because that's the counter. It's a double.
No,
It's
no.
a doppelte Buchführung, yeah.
Yeah.
It's double
No,
entry
Michael,
bookkeeping.
really, if the EFSF, for example.
Okay, but maybe that's not an ECB official monetary institution.
No,
so I'll
that's
buy
outside the ECB.
Okay, fine.
So
If
I
it's
talk
outside the
about
ECB.
these fiscal institutions.
Okay. That's different.
They
I
have
buy that.
provided credit to Greece. And providing credit means you make a payment order through the banking sector.
No, I understand that. I thought you were talking
And
about
that
ECB
reduces
credit.
the target.
Okay, that makes sense. If it's an extra ECB agency that's lending money to Greece, then
Yes.
that counts
But
as a
it
capital.
is still lending money, it's not taking the losses.
Well, it's a loan. It's a capital
Still
flow.
no
It's
one
a
is
capital
taking-
flow.
No one is taking
It's
the
a
losses.
public fiscal credit flow to Greece, which reduces the need to draw the credit out of the Greek printing press. And therefore, the target balances go down in the case of Greece. In the case of Spain, it is more private capital, which is encouraged to be sent also through payment orders to Spain because of the OMT. But the OMT is a hidden form of government debt. Suppose Germany, for example, which is one of the countries which absorbs gives the guarantees for the OMT, would borrow, lend the money to Spain, and faces then the risk that the Spaniards would not repay, would have the same risk as under the OMT. But then if you recalculate the thing this way, you would see that Germany would have to borrow. So giving guarantees is implicit borrowing. That means if we did it in a slightly different way, the same economic operations, our debt GDP ratio would go up by our share in the Spanish extra borrowing. So it's just a camouflage activity. Giving the guarantees is not booked anywhere. And therefore, one has the illusion that there is not a risk.
That's all true.
It sounds
but
a lot
suppose-
like the financial market.
Can I try one more thing? It's not just finance that drives the target. If Spain starts to export like crazy to Germany, suppose Germans just get really interested in buying Volkswagen cars that are made in Spain, Seat, whatever, and they start importing them, and Spain has a small surplus. If it's a bigger surplus, that will actually, ceteris paribus, will reduce the target balances.
That's true also.
Right? So it's not just a financial thing. It's not just capital flight or Germany pushing money down there. It's also, if we get the export, going
Yeah,
again,
that's right.
and if Spain stops importing so much German stuff, that would also help. So I mean, it's a big picture. It's like
Yes, it's also that, of course.
just trying to spread some
But
optimism.
the current account in Spain has improved. It's not through a surge in exports. The exports are hardly
of
back to
imports.
previous trend. The collapse in imports due to the mass unemployment.
Right.
So people have no incomes, they cannot afford the imports.
You're a Dr. Doom, you know that? You're the new Nouriel Rubini.
So I think Franz is asking.
Me once more, I forgot to say who I am, Franz Hubert from Humboldt-University. I have another question coming back to the ECB proper. We discussed the possibility and the pros and cons of a country like Greece exiting the euro. But there is actually no way to kick them out. So basically this would have been the decision by the Greek government to default and, by the way, then leave the euro, which is actually quite a different decision to make. You can default and still be in principle at least. Now, at the same time, Professor Sinn told that the decision-making in the euro, in the board of the ECB is actually very much to the favor, if you look in terms of voting power, of exactly these countries. So my question is, I think we identified a number of developments which is not really very good. And the question is now, where should the pressure to reform all this actually come from? It will not be that the Greek government threatens to withdraw, perhaps because it eases regaining competitiveness in the world. That would make sense, but in terms of power in Europe, this would be a very stupid thing to do. So I mean, who can put pressure on the ECB to reform its decision-making process and also to narrow down its mandate again, because you rightly criticize that they basically set their own agenda. This is not a democratically elected body at all, and they have vast powers to transfer resources within Europe. That's what we all established. So who is going to change this? I mean, that makes me the point more sharper. Isn't it the only option that countries like Germany, which at present, perhaps not always in the future, but at present, are on the giving side, threaten to go out and go back to the Deutsche Mark in order to push for change?
That's right.
I mean, we had the election right now with a party which has this on the agenda.
Let's take this question before we have some final, hopefully slightly more positive words. I'll try and frame the question properly. So Jörg, should Germany threaten to leave to get bargaining power?
I don't think the threat is currently very effective, given the claims Germany has towards the system, that many of these claims might actually not be worth anymore. So therefore, say the bargaining position, in my view, is actually not a very strong one. But nonetheless, and this actually was part of our discussion already, I think it's good that there is now the hearing. There was a hearing, that there's a decision by the Federal Constitutional Court, and we'll see what comes out of this. And it's good that this topic is now brought up there, and we'll see what comes out of this.
Yeah, I agree. So we have a very bad threat point because we have, what is the target balance now? 570 billion claims against the ECB system. And we will lose these claims in all likelihood if Germany decides to exit the euro. A British journalist recently has explained that very well with the term, they're on the hook. Like a fish is on the hook, he can move, it doesn't improve the situation. But we have to threaten with something. We have to, we should make this an issue. We should officially make the ECB policy a public debate. We should ask other European countries to renegotiate the Maastricht Treaty because of to change the ECB rules. I think all the rest is futile because the ECB takes the initial decisions and then all subsequent decisions follow. As I explained, the ECB bails out the banks of Southern Europe, and then we have to bail out the ECB. The problem is that the ECB begins to bail out. The same by giving refinancing credit against bad collateral to the southern banks. That was the first wave of the crisis. And now comes the second wave with the OMT program, that the ECB now even finances the governments or offers to do so. And it will be challenged at some stage when there's the next crisis for the states, then the ECB really has to buy these government bonds, then it's the next step. And then when it is sitting on these government bonds of the southern European countries, and these are under risk and a default is near, what will happen then? Then we will have euro bonds to rescue the ECB again. So all these measures are a path dependency, describe a path dependency where the parliaments come at the end of the chain and all the relevant decisions have been made by the ECB Council. And if we understand this game, then there's only one possibility, doing what you said, really attacking the ECB.
Okay.
Yeah, and really change the rules of the game, because that's the origin of everything.
So going forward, how do we rescue Europe? And now everyone has about half a minute to give an answer. Maybe starting with Michael?
Europe has managed for thousands of years to negotiate all sorts of solutions and has also managed to fight wars. As an American, I think it would be nice to see them resolve this peacefully. And I think there's a good chance of doing it. I think the Germans have to discover their threat point, maybe improve their threat point. And maybe leaving the euro is a credible threat. I mean, it depends on what you think the costs of staying in are. versus the cost of exiting. And if it's just 570 billion, you know, we can balance that against something else. I'm not sure. I'm just not optimistic that it's worth that much to leave. So maybe the point would be to try to develop coalitions of countries. And maybe it means, like I already said this in a provocative way, but you know, if Germany gives up the Bundesbank, the French would have to give up the Banque de France. And the new ECB would be a set of regions like the United States has the Federal Reserve regions, which cut across state lines. The states of the United States cannot threaten to be, you know, to go bankrupt, and the Fed just laughs at them. So Michigan is almost bankrupt right now, but the Fed will never bail out Michigan, right? And Michigan taxpayers know that, Michigan bondholders know that, and the rating agencies know that from the beginning. And you know, making France and Germany and part of Italy a new ECB district would make it very difficult for banks to get in cahoots with the national governments and threaten, et cetera. So that's my dream solution. I think that would be really, you know, I don't think it's going to happen, but it would be a great idea.
So you stretched the half minute, but you also were creative, and there's no chance of discussing this seriously in the next 2 times half a minute.
So I think we have basically, we just, so to say, you could call it a gift. We have the gift that through the decision by the ECB to basically to take whatever it takes, that now there's time to tackle really the reforms. Now the time has an advantage and a disadvantage. The disadvantage is that everyone thinks, okay, we don't need to do anything anymore because everything seems to be going well. I'd also like to take the positive approach and just say, let's use the time now to really tackle those things that are so important, which is in particular to come back to a bail-in, and a bail-in not just be seen as a technical thing, but something that is so fundamental for a market economy in which everyone knows if I make the wrong investment decision, I will lose my money, and that means ex ante taking the right investment decisions and not just relying on anyone, in particular the taxpayer, to bail out.
Thank you. And Hans-Werner Sinn again, half a minute on a positive outlook.
Yeah, I think we can preserve the euro if we make it a breathing euro, where you allow for exits and re-entry, if you define the rules under which this can happen, so that in the moment it might be a catastrophe, but there are rules which make it an orderly process. And we have to resolve the over-indebtedness problem by big write-offs. We need a debt conference in Europe. And we should begin also by identifying a number of countries which temporarily try it outside and return later when they have done their reforms and are competitive. The earlier we recognize the reality, the better it will be for the peace in Europe.
And now we have to recognize the reality that we're over time. So thank you all for joining and coming. I fear we should discuss for hours more. There are drinks back there and some snacks, so you're all invited to join us over there. Thank you. And thanks to panelists.